And I'm here with Julie Babcock Hyde. She is the owner of Spark Accounting Solutions. She is a CPA, CFM, QuickBooks Pro Advisor, Profit First Professional, and the list goes on. Welcome, Julie. It's great to be with you today.
Hey, I am happy to be here. And I will say that I am talking about one of my least favorite subjects,
Well,
which
I
is
have no. Go
which
ahead.
is proposed tax laws, because they aren't real and final yet. They're
Okay.
all, wishy-washy, but there's been so many questions. I wanted to address some of the big items that could affect small to medium businesses.
Perfect. I think it's good. And honestly, when we first started talking about this topic, I thought maybe this is like, things you always wanted to ask about the proposed tax bill, but we're afraid to ask. Like, especially as a small business owner, right?
Yeah. Yeah. And there's been a lot of noise about it because we have a new president in place, a lot of noise about changes, a lot of noise about differences. And so want to really kind of go through those. And if there are follow-up questions, feel free to comment as we're going through this. And if I know the answer, I will answer it. And if I don't, I will get back with you.
Okay, perfect. Yeah. And even if you're watching the replay, leave a
Yes.
comment in the video. Okay. So Julie,
Yes.
I'm kind of excited to get into it because we might as well just knock it out.
Let's do it.
Okay, perfect. Number one, dun, 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 the top marginal tax rate will be increased from 37% to 39.6%. And honestly, the first thing out of my, mouth, the first idea that pops in my head, how many people is this really going to affect?
This is really going to affect people. Our current president has said like he really only wants to raise taxes on people that are making over $400,000 a year.
Okay.
So a lot of our small business owners, especially when they're first starting out, aren't probably going to be there anyway. But this particular increase in this particular bill in the American Families Plan would put this increase in play in 2022. So that would be for the taxes that you file in 2023. So it's not like effective now if it passes. But I want to point out that this tax rate would be going up anyway in 2025 because the current provisions for the lower tax rate is expiring. So this really is only going to apply to single and head of household taxpayers with an income over $452,000. And for joint filers over 509,000. Now I rounded because I was being lazy with the numbers. But so this really is those people that have built their business and are not knocking it out of the park, doing well, successful. This is probably not going to hit most of our startup small businesses, but the larger clients that have been running for a while definitely could come into play for them.
Okay. All right. What else do we need to know about that?
Really, it's an extra. Remember that our rates are marginal. I guess that's the other thing is that so the first set of your income is taxed at 10% and then 15%. And then, so it's not that all of your income is going to be taxed at this high marginal rate, just the portion over those numbers that I mentioned. So even if you're at 453,000, only $1,000 is going to be taxed at this highest rate.
Okay. That's really useful. Yeah.
Yeah. A lot of people freak out because they're like, oh my gosh, everything's going to be taxed at this, but it's marginal. So it's brackets.
All right. Perfect. All right. Let's skedaddle on to number two.
Okay.
First, tell us what NIIT is.
This is net investment income tax. So this is an additional 3.8% that typically has only been applied to higher income earners and their investment income, dividends, capital gains, those kind of things. Now, this tax bill is proposing to also apply this to active pass-through income. Now, what the heck does that mean?
I'm hoping you're going to tell us.
I am.
Okay.
So for those of you that have implemented an S corporation strategy where your business is taxed as an S corporation and part of your earnings comes through as wages and part of your earnings comes through as net income from the S corp. This is that net income from the S corp that you get a K1 on and it goes onto your Schedule E on your 1040. This is the pass-through income. This has in the past not been subject to this if it was an active business, but now they're looking at doing this for S corporations and partnerships. Now, my belief is that part of the reason they're doing this is because there's a lot of abuse in the S corp world on avoiding employment taxes by paying yourself a really, really low wage. And they aren't doing a ton of audits around that. So I think this is kind of a way to help boost revenue without increasing those audits because they don't really have a ton of resources for that right now. But if your tax strategy is S corporation or partnership, if this law passes, you are going to want to talk to your tax advisor and talk about, is this still the right entity type for me? Or does it make sense to look at doing a different entity?
Okay. This is why people like you exist, for people like me who, when they hear this, their head hurts. So,
Well, I hope that it's making sense. So if it doesn't make sense to you, please ask me a follow-up question so that we make sure we explain all of this in plain English for people.
yep, absolutely. And again, anybody who's watching this now or, in the replay, if it's not making sense, ask for clarification. Because
Absolutely.
like Julie said at the beginning, if she doesn't know, she'll find out. So awesome. Okay. All right. Number 3, increase of tax rate on long-term capital gains. Lots of increasing going on.
There's increasing going on. There's been lots of spending going on lately. And so there's lots of increasing in the revenue side of things to fund some of the stuff we've done.
Okay.
So this is specifically for taxpayers with income over $1 million. And so this is increasing the tax rate on capital gains and qualified dividends. Right now, the top rate for long-term capital gains and qualified dividends is 20%. This would bump that up for people over $1 million. Now, this is one of the proposals that is really causing a lot of heartburn in my industry because it's actually got a proposed retroactive effective date to this year. And it's before the date that this bill has even been passed. And so the reason that they did that was because if people knew it was coming, they could sell their assets, take care of their capital gains, get it at a lower rate, and then repurchase something. And they don't want that. They want the tax revenue from this. So that's why they
might as well call it like it is.
Well, it is. That's why they're backdating it, is because they don't want people to. They really are kind of taking away the, hey, we're not going to tell you this rules. We don't want you to know this is coming and take advantage of the current rules because we want the revenue.
So I want to ask you.
Yes.
Because I can imagine a lot of people getting triggered by this. Little money's important, right?
Yes, money is important.
These are proposed changes. Yes. These have not passed yet.
That is correct. These are all proposed. Okay. So no need to panic right this second, especially on this one. The retroactive date's already passed. So the retroactive proposed date is already passed. So a lot of this stuff, we just have to wait and see how it plays out because it's not final. There's still discussions. Let's be honest, our government is arguing about other more important things like avoiding a shutdown right this second. So this is probably not at the top of their conversation list this week. So just wait and see how things play out. My frustration as an accounting professional and as a tax advisor is, why do we keep changing the rules retroactively?
Oh, I can imagine. Yeah.
It's not fair to people. It's not fair to taxpayers. We are supposed to be allowed to organize our affairs in whatever manner is legal and saves us the most taxes. We are absolutely allowed to do that. And when we don't know what the rules are, it's like winning Monopoly and then being like, oh, actually, the person with the least amount of money wins. Totally changing the rules of the game. It's not fair. It's not fair. Right. And I will say that till I'm blue in the face, but This seems to be, for the last many years, this has been kind of normal where we're getting tax law passed in the end of the year, retroactive back to the beginning of the year, or we even had some tax bills passed the year after, retroactive to the beginning of the prior year. And it's just like, it's not fair to change the game, to change the rules in the middle of the game, and certainly not after the game's already over.
Yeah. I mean, there's nothing more that can be said about that.
No,
It's just you're calling it like it is. Okay, let's move on to number
it
4.
is.
Like we can,
It's unpleasant, but
yeah,
it's the world we live in right now. So
it is. It just is. It is what it is. Okay, here we go. Yeah. Okay, so the next one, number 4, limits to Roth IRA conversions. What does that look like?
okay, so let's talk about Roth IRA conversions just in general. There's two types of IRAs. There's traditional IRAs and there's Roth IRAs when you're talking about just an individual type of IRA. With a traditional IRA, that money goes in as a deduction this year. It grows tax-free, and then when you take it out, it's taxable. With a Roth, that is not a current deduction. It goes in with after-tax money. It grows tax-free, and then you get to take the money out when you get to retirement age, and you don't have to pay taxes on it because you already pay taxes in the year you contributed it. So those are the two vehicles that people use when they don't have an employer-sponsored plan. So with the Roth, the idea of contributing now and not paying taxes later has some real attractive qualities to it, right?
Mm-hmm.
But there are income limits to who can actually participate and contribute to a Roth. And so what a lot of people have done is they found a way, and it's called a backdoor Roth, where they contribute money to a traditional IRA that's non-deductible,
Okay.
and then they convert that over to a Roth IRA. And there's a conversion process for that. And so they basically can put it here, switch it over, and they get the Roth treatment going forward. Backdoor Roth. And so they want to get rid of that. And that's the way higher income people that have not been able to do the Roth have gotten into this.
Okay.
So closing this door is a loophole that's that people have taken advantage of. Totally legal. When I say loophole, I don't mean anything illegal's going on. It's
Right.
totally
I wouldn't
legal.
imagine that you'd be sharing, here's an illegal
No.
tip you can use. Yeah.
But this is something they're proposing to make go away so that they close that door. Again, it's going to primarily impact people with higher income levels that we're doing this anyway. And if you really want to do a Roth, talk to your tax advisor, talks to your financial advisor, and see if it makes sense at your business to implement a 401k with a Roth option. There's still a way to get around this. There's still a way to do these things. You just might have to change the vehicle that you're doing it with.
Okay. And again, this is proposed?
Still proposed.
Okay.
It could not happen.
You don't have to call your CPA today.
That is correct. You do not have to call your CPA today unless you call them to just say, hey, if this happens, can you yell at me and let me know?
Perfect. Okay, good. Okay, good tip. All right.
Yeah.
Number 5, another increase. Wow.
Another
surprise.
Increase. Now, this one there's been a lot of buzz about some of the increased tax compliance activities that have been proposed in this. And I think one of the ones that you probably are the most buzz about, if you've heard about it, is that they're going to ask the banks and the financial institutions to start reporting on like the total inflows and outflows of any bank account over $600. So what they are trying to do is close the gap on people that are not reporting all of their taxable income. As a taxpayer personally, and a tax preparer, I am all for everybody paying in their share of the taxes and taking advantage of every tax law that is to their benefit. But I am not a fan of tax evasion. And well, I really don't like people looking at that. I probably have a little bit different feelings than most people have about this because I deal with the IRS all the time.
Yeah.
I know they really don't have time to dig into what's going in my personal account and out of my personal account, but the goal is tax compliance. They've got some other things they're trying to do to help the IRS, update their systems. The IRS is operating on systems from 1960, and
What?
yes, in like programming code that's not even really taught anymore. So as like all of these crazy things have been happening the last few years, they've been like trying to find programmers who have retired who still know how to program this code to make
Wow.
changes to their
Wow.
system.
Wow.
So they're trying to modernize their system, which would give them which would be, I think, great for everybody if we had a more up-to-date system. But that is all going on. And I just encourage people that are, if you're reporting all of your income, this is not something, this $600 thing is nothing to be scared of. Nobody likes the IRS in their business. I understand that. But again, if you're reporting all your income, there's nothing to be scared of. If you are running around buying things off of Facebook Marketplace and reselling them and making money all the time that you're not reporting, you might need to be nervous about this because they
Okay.
might notice that that's going on. And so you might need to get serious about tracking the income that you're making from that, because what they're going to see is the inflows, and they're not necessarily going to see all the outflows and know to match them up so they know what your net income is.
Mm.
And so if you have one of those businesses like that you're kind of running on the side under the table, yes, you should be reporting it, period, anyway. But with this potentially coming, it may be time more than ever to kind of get a little bit, go ahead and get legit and start tracking your income and your expenses associated with that, so that when and if you decide to report it sooner
Yeah.
rather than later, because you're supposed to,
Yeah.
you have the data so that you can actually deduct your expenses.
Okay. There it is. That's good. We've got some bonus info. Before we go there, I want to pull up some comments that have come in through the live broadcast. So Michelle Jones says, "Thanks, Julie. You're always such a great advocate for people and full of such great advice and information." Absolutely. Thank you, Michelle.
Thank you for that.
And then Matthew Fulton says, "Software developers are in high demand." No doubt
Yes,
there.
yes, they are.
And he also says, rumor has it they are backing off the 600 to 10,000. Huh.
It will be
Interesting.
very interesting to see, because there has been a lot of people very upset about, why are you looking at my $600 bank account?
Right.
That's exciting going on in here.
Yeah.
Let's get that up to a more reasonable threshold. And so
Yeah.
there's a lot of rumors about a lot of things in this bill. And so
Gee, that's unusual.
that is so unusual. And so I do expect, like, what we talked about today probably won't be final. And so it's going to be really important for you to really, keep track of, kind of try to keep track of what's going on with this. But more importantly, once we know what the final rules are,
Yeah.
reach out to your tax preparer and just say, and not to I'm going to say more than your tax preparer, your tax advisor.
Yes.
Because if
Yes.
you're just paying somebody to prepare your return, they may not be able to advise you on, changes you can make. So
Yeah.
reach
Good.
out to your tax advisor sooner rather than later. Maybe wait till after October 15th, since they have an extended tax deadline. But if you're concerned about anything right now,
Yeah.
you reach out and say, hey, can we talk about what the
Okay.
impacts of any of this could be for me?
And the reason to wait till after October 15th is mostly because all the tax advisors are crazy busy right now, right?
Yes, it is.
Yes.
The extended deadline is coming up in just a couple of weeks for folks for the extended 1040s. And so it's been another crazy year for tax season for folks. And so maybe let them get through that, and let them breathe. They'll appreciate that.
Might as well. Might as well, right? Because it's all proposed right now anyway.
That's correct.
Right. Okay. So Matthew says, I just love how it's described. We only ask for two things: what goes into your bank and what goes out. Just not much, really.
Just everything.
Yeah.
It's
We
cool.
just want all of it. That's all. Yeah, good point, Matthew. Okay, perfect. All right, so let's move on to the bonus info. And this is a little bit more positive.
Yes. Like,
Okay,
as you
cool.
kept saying, another increase, another increase, another increase. And they weren't the good kind of increases, like increased sales. It was like, oh, increased taxes.
Right,
So
right,
let's
right.
talk about some benefits that
Okay,
might come out of this
please.
for small business owners. So the
Okay,
first
perfect.
one that I want to talk about is the extension of the enhanced child tax credit through 2025. And this is providing $3,600 for children under 6 and $3,000 for children 6 to 17. This was expanded, and this bill, if it passes, would extend it all the way through 2025. So those of you that are business owners with kids, this could be a plus for you. Another thing that is getting extended potentially with this, in the American Rescue Tax Act, they made some changes to the child tax credit, the earned income tax credit, and dependent care credits. And this bill, if it passes as it's written right now, would make those changes permanent, which again expands like the availability of those credits to some people. The last one that would be made permanent, this is in play. The American Rescue Plan Act already made, I'm going to call it enhanced premium tax credits for health insurance for folks. It used to be that you could only get a premium tax credit if your income was under 400% of the poverty level. They changed the rules a little bit because healthcare was getting so expensive. They put like a percentage of your income that it couldn't go over, or you could get credits. So that is in play in 2021 and 2022. The bill, as written, if passed, would make those changes permanent to again help make health insurance a little bit more affordable. I don't know if you've priced a health insurance plan on the marketplace, but it's a good chunk of change unless you're
It's not
young and
cheap.
healthy. Yeah,
Yeah,
and
it's not
so
cheap. Hmm.
yeah, and so they put this in place because they were noticing that because of increases in health insurance, this was eating up a large percentage of income for a lot of even higher income folks. And so they put that cap in there. So those are three potential benefits that would be that are in there if it passes that might help you out.
Awesome. Thank you. Thank you. Thank you, Julie. We have one question real quick from Matthew. He says, have you heard about any rental assistance for commercial properties?
I have not at this time. Matthew, I'll take a look and see if I see any talk on that, but I have not been looking for that specifically. But I
Great
will.
question, though.
It is a great question
Yeah.
because there's a lot of pain in the property owner world right now with
Yeah.
some of the eviction moratorium, and what do we do if people aren't paying, and what do we do if commercial tenants aren't paying? Like what is there out there to help these folks? So that's a great question, and I'll
Yeah.
look and see.
Awesome. Okay. So you'll get back with Matthew. Will you put it in the comments too so everybody can?
Absolutely.
Perfect.
Absolutely.
Awesome. All right, Julie, as always, and as Michelle said earlier in the broadcast, always great information. Thank you so much for this. And you do have a free giveaway to specifically help small business owners. The 5 core chapters of Profit First. I love this because who wants to read a whole book? Just get the 5 core chapters. So you can get those free at bit.ly/sparkpfbook. The URL is scrolling across your screen right now. Go ahead and screenshot, take a picture of it, whatever helps you. We will also put that in the comments and in the description of the video.
Awesome. And remember, there's some tips in that book to help you save for taxes so that if you do have to pay these extra things, you might have money set aside to do that.
Hypothetically.
Hypothetically, yes.
All right, Julie, thank you so much. Thank you to all the viewers. Everyone have a great rest of the day, and we will be around. Julie, if people want to contact you, just the contact us button on your Facebook page, right?
Yep, that is perfect.
Perfect. Okay. All right. Bye, everyone. Thanks, Julie.